If you're here, you're not a beginner. You've felt the rush of a perfect trade. You've also felt the sting of a losing streak that seemed to come out of nowhere. You've spent countless hours analyzing charts, backtesting strategies, and searching for that one elusive indicator that will finally unlock consistent profits. But what if I told you that the secret to consistent trading success has very little to do with your analysis and almost everything to do with what's happening between your ears? In this comprehensive series, we are going to dive deep into one of the most transformative books ever written on trading psychology, Mark Douglas's Trading in the Zone. This isn't a book summary. This is a deep dive, a masterclass designed to rewire your thinking. We're going to dissect the core mental frameworks that separate the consistent top 5% of traders from the 95% who struggle with frustration, fear, and inconsistency. We will cover the fundamental paradox of trading and why it makes it so difficult, how to truly, deeply accept risk so it no longer generates fear, the power of thinking in probabilities just like a casino, how your beliefs literally control what you see on the charts, and finally, how to cultivate the elusive zone where trading becomes effortless and disciplined. This is for traders who are ready to do the real work, the work on themselves. So, get comfortable and let's begin. Mark Douglas starts his book by taking us through a brief history of trading analysis. First, there was fundamental analysis. Then, the world discovered technical analysis, which was a massive leap forward. It focused on what the market is doing, not what it should be doing based on a model. But Douglas makes a crucial point. The vast majority of traders who learn technical analysis hit a wall. They can look at a chart and see the patterns perfectly. They can predict what the market will do with surprising accuracy when they're not in a trade. But the moment real money is on the line, something strange happens. They hesitate, they jump the gun, they let losses run and cut winners short. They break their own rules. Douglas calls this the psychological gap. It's the Grand Canyon-sized chasm between knowing what to do and actually being able to do it consistently under the pressure of real-time, real money trading. This gap is the source of our frustration, and you cannot close this gap with more market analysis. You close it with mental analysis. The consistent winners, the professional traders, have made this shift. They understand that while analysis is necessary, it is not sufficient. The defining characteristic of a successful trader is their mindset. Let me give you an analogy Douglas uses. Imagine the moon represents consistent trading success. From our perspective here on Earth, the moon seems close, almost within reach. On any given night, it's right there. Trading feels the same way. The markets offer a constant, flowing stream of money. It seems so close you could just reach out and take it. For the consistent winners, that money is within their grasp. They can take it almost at will, but for the vast majority, it's an illusion. Just as they reach for it, it slips away, time and time again. The only thing that's consistent is the emotional pain, the fear, the anger, the frustration, the regret. So, what's the difference? Is it intelligence? Are the winners just smarter? Absolutely not. Douglas points out that some of the biggest losers in the trading world are doctors, lawyers, CEOs, and brilliant scientists. In fact, many of the best market analysts are the worst traders. The difference is not in the quality of their analysis. The difference is in the quality of their thinking. The consistent winner has attained a mindset, a unique set of attitudes that allows them to remain disciplined, focused, and above all confident in spite of the constant uncertainty. They are no longer susceptible to the common fears and trading errors that plague everyone else. Your mission, should you choose to accept it, is to acquire this mindset. So, why are we so attracted to trading, and why does it so often lead to pain? Douglas suggests the primary attraction is freedom, unlimited creative expression. In the markets, we make almost all the rules. There are very few external boundaries on how we can express ourselves. But this unlimited freedom is a double-edged sword. It's a gift and a curse. The gift is the control. The curse is that there are no external structures to guide our behavior. Think about it. In a casino game like blackjack, the rules force you to decide your bet before you play. The game has a defined beginning, middle, and end. You can't just decide to stay in a losing hand indefinitely. Trading has none of that. Nothing happens until you decide. It lasts as long as you want. It doesn't end until you end it. This boundary-less environment is something we are completely unprepared for by society. This lack of structure is incredibly dangerous. It allows you to become a passive loser. In a gambling game, you have to be an active loser. You have to reach into your pocket and place another bet to keep losing. In trading, you can just do nothing. You can ignore a losing trade and the market will happily take everything you have, and more. This environment requires an internal mental structure, a discipline that must come from within. And this is where our psychology fights back. Douglas outlines several key problems. First, the unwillingness to create rules. We are naturally resistant to creating rules because we've spent most of our lives trying to break free of external rules. The very freedom we crave makes us resist the discipline we need. Second, failure to take responsibility. When you have complete freedom of choice, you also have complete responsibility for the outcomes. Most traders don't want this. It's easier to trade randomly or blame a tip, a broker, or the market for your losses. If the outcome was random, you don't have to confront the fact that your interpretation or execution was flawed. Third, addiction to random rewards. This is a powerful one. Studies show that if you reward a monkey randomly, it will keep performing a task indefinitely, even after the rewards stop. Why? Because it never knows when the next surprise reward is coming. Traders get addicted to the random big win. It feels so good that it compels us to keep trading, even when our overall results are negative. We're hooked on the possibility of that next euphoric hit. And fourth, external versus internal control. In life, we learn to manipulate and control our external environment to get what we want. You can't do that with the market. The market doesn't know you exist and doesn't care about your hopes and dreams. The only thing you can control is yourself, your perception, your interpretations, and your actions. This leads us to the first pillar of the professional mindset, taking absolute responsibility. I need you to listen carefully because this is perhaps the most difficult concept to truly internalize. Taking responsibility does not just mean saying, "Yeah, I know it's my fault." It means acknowledging and accepting at the deepest level of your identity that you, and only you, are responsible for your success or failure as a trader. The market is neutral. It doesn't do anything to you. Its purpose is not to give you money or to take it from you. Its purpose is to facilitate the transfer of money between participants. From its perspective, every single tick is an opportunity for someone to get in, get out, take profits, or cut a loss. When you blame the market, you are essentially expecting the collective actions of millions of strangers to behave in a way that fulfills your personal expectations. That is absurd when you think about it. Do you feel responsible for fulfilling some other trader's hopes and dreams? Of course not. So why would you expect them to do it for you? When you don't take responsibility, you set up two massive psychological obstacles. One, an adversarial relationship with the market. If you blame the market for your pain, it becomes your enemy. How can you possibly flow with something you are fighting against? You can't. You'll be constantly tense, defensive, and out of sync. And two, the illusion that more analysis is the solution. If the market is the problem, then the solution must be to learn more about the market. This is a trap. You will dive deeper and deeper into analysis, creating what Douglas calls the black hole of analysis, only to find yourself more frustrated because you're still making the same psychological errors. But when you take absolute responsibility, everything changes. The market is no longer your enemy. It's simply a provider of endless opportunities. If a trade loses, it's not because the market betrayed you. It's because you interpreted the information in a way that didn't work out this time. It's feedback. It's a lesson to be learned. This is the foundation of a winning attitude, a positive expectation of your efforts, combined with the acceptance that whatever results you get are a perfect reflection of your current level of development and what you need to learn to do better. To understand why we behave the way we do, we need to understand how our minds process information. Douglas gives a brilliant breakdown of the dynamics of perception. Think of everything in the environment as generating information. A rock has texture, color, shape. It generates information that our senses pick up. This information gets transformed into electrical energy and stored in our minds as memories, distinctions, and beliefs. These memories and beliefs are not physical matter. They are structured energy, and this energy has a profound effect on what we perceive. Let me give you Douglas's powerful example. Imagine a young child encountering a dog for the first time. He's curious, excited, but this dog is mean and it bites him. The experience is traumatic. It gets stored in his mind as a memory, charged with the negative energy of fear and pain. Now, imagine that child encounters a second dog months later. This dog is the friendliest, happiest golden retriever you've ever seen. What happens? The child is terrified. He freezes, he cries. Why? Because our minds have a built-in automatic function, the power of association. The outside dog looks similar to the inside memory of the first dog. The mind links them instantly. This link releases the negatively charged energy from the memory, and the child feels fear. Then, something even more profound happens. The child's mind associates the painful fear he's feeling with the dog he is looking at. He projects his internal pain onto the external dog. So, he doesn't see a friendly dog. He perceives a threatening, dangerous animal. His internal reality becomes his external truth. This is exactly what happens to us as traders. Let's say you have 3 losing trades in a row. Each loss is stored as a memory with negative emotional energy. Now, you see a new trading signal. It's a perfect setup according to your system. But what happens? Your mind associates this now moment setup with the painful memories of your last 3 losses. It taps you into that fear. You hesitate. You start looking for reasons not to take the trade. You perceive the trade as risky. The signal feels weak. You might even talk yourself out of it. And then, of course, the trade works perfectly, and you're left kicking yourself. Now, flip the scenario. You've had 3 winning trades in a row. You're feeling great, confident. You see the next signal. Your mind associates this with the euphoria of your recent wins. You perceive the trade as a sure thing. You might even over-leverage, break your position sizing rules because it feels so right. In both cases, the market generated the same neutral signal, but your internal mental state, charged by your most recent experiences, completely altered your perception of that signal and your subsequent actions. The threat, the fear, the overconfidence, it doesn't come from the market. It comes from the way your mental energy interacts with the market's information. The market is just a stream of upticks and downticks. You are the one who charges that information with meaning. So, if our minds are constantly associating the present with the past, how do the pros stay focused? How do they see the market so clearly? They operate from a fundamentally different belief about the market's most fundamental characteristic. Mark Douglas says that if there is a secret to trading, it is this: a strong, virtually unshakable belief in an uncertain outcome. The best traders don't just give lip service to the idea that anything can happen. They believe it with every fiber of their being. This belief is so powerful that it acts as a buffer. It prevents their minds from automatically associating the current trade with their last few trades. Why is anything can happen the truth? Let's break down the market to its core components. The market is made of people. People who buy because they believe the price will go up, and people who sell because they believe the price will go down. Price movement is a function of belief. Now ask yourself, what is going to stop one person anywhere in the world with a strong enough conviction and enough capital from acting on their belief? Nothing. Other than exchange limits, nothing at all. Douglas tells a great story about a brilliant market analyst who was explaining a perfect support level in the soybean market to a veteran floor trader. The analyst said, with absolute certainty, the market will stop and reverse right here. The veteran trader said, "Bullshit. Watch this." He picked up the phone, sold a massive amount of beans at the market, and single-handedly drove the price down 10 cents in 30 seconds. He turned to the stunned analyst and said, "If I can do that, anyone can." The point is, from your individual perspective, it only takes one other trader to negate your edge on any given trade. There are always unknown hidden variables, traders on the sidelines, large orders, a news event you haven't heard yet. The professional trader knows this. They don't pretend these unknown variables don't exist. They factor them into every single trade. How do they do that? By always predefining their risk, by always having a systematic way to take profits, by always cutting their losses without hesitation. The typical trader, on the other hand, acts as if what he can't see doesn't exist. He trades as if he knows what's going to happen next, and that is the source of every single one of his errors. This brings us to the core thinking strategy of the professional, thinking in probabilities. This sounds simple, but it's a profound psychological shift. To illustrate it, Douglas uses the perfect analogy: a casino. Think about a casino in Las Vegas. They spend billions on lavish hotels to attract people to play games that have purely random outcomes: blackjack, roulette, craps. The outcome of each hand, each spin, each roll is statistically independent. It's random. Yet, the casino makes consistent profits day after day, year after year. How? Because they have a small statistical edge and they play a large enough number of hands for that edge to play out. In blackjack, the house might have a 4.5% edge. They don't know if they'll win the next hand or the next 10 hands, but they know with a high degree of certainty that over 10,000 hands, they will be net winners. This is exactly how the best traders operate. They understand two conflicting truths simultaneously. One, the micro level. Each individual trade is a unique event with an uncertain random outcome. They do not know if it will be a winner or a loser. And two, the macro level. Over a large series of trades, their edge will produce consistent positive results. They do know that if they take every valid signal, they will be net profitable. The amateur trader gets this completely backwards. At the micro level, he desperately tries to know which trades will be winners. He picks and chooses, he hesitates, he tries to predict outcomes, and at the macro level, he has no consistency, so his results are random and usually negative. The professional, like the casino, doesn't care about the outcome of the next trade. They are committed to taking every trade that meets their edge's criteria. Why? Because if they don't, they are invalidating their own system. They are saying, "I think I know which edges will work," which is a contradiction to believing in uncertainty. When you truly think in probabilities, you stop trying to be right on every trade. You just want to be right over the long run. This eliminates the emotional attachment to any single trade. A loss is just the cost of doing business, like a casino paying out a winning jackpot. It's a statistical necessity, not a personal failure. So, how do we practically implement this? By managing our expectations. Our expectations are the primary source of our emotional pain. An expectation is a belief projected into the future. When the future doesn't match our expectation, we feel pain, disappointment, anger, frustration, betrayal. In trading, if you expect a trade to be a winner, and it isn't, you will feel pain. Your pain avoidance mechanisms will kick in. You'll rationalize. You'll hesitate to cut the loss. You'll distort information to make yourself feel better. The solution is to adopt expectations that are perfectly aligned with the true nature of the trading environment. Mark Douglas gives us the 5 fundamental truths to internalize. 1. Anything can happen. You must believe this completely. 2. You don't need to know what is going to happen next to make money. Your edge takes care of that. 3. There is a random distribution between wins and losses for any given set of variables that define an edge. Wins and losses are randomly distributed. A loss does not mean your next trade is more likely to be a loss. 4. An edge is nothing more than an indication of a higher probability of one thing happening over another. It is not a guarantee. And 5. Every moment in the market is unique. No 2 setups are ever exactly the same beneath the surface. When you integrate these 5 truths into your core belief system, your expectations become neutral and open-ended. You don't expect a trade to win. You expect that something will happen, and you have a statistically verified reason to believe one outcome is more probable than another. You are simply making yourself available to find out what will happen. With this mindset, there is no emotional risk. There is only financial risk, which you have predefined and completely accepted before you even enter the trade. A losing trade is not a failure. It's simply a trade that didn't work out. It's part of the process. You exit, you thank the market for the information, and you wait for the next edge. This is how you eliminate the struggle. This is how trading becomes easy. Knowing these truths intellectually is not enough. You have to make them functional. You have to install them at a deeper level than your fears and your old, flawed beliefs about trading. This is the real work. This is where you debug your mental software. So, how do you do it? First, awareness and acknowledgement. Start by observing your own thoughts and emotions during trading. When you feel fear, ask yourself, what belief is causing this? Am I expecting to be right? Do I not accept the risk of this trade? When you feel euphoric, ask, am I being reckless? Am I assuming I know what will happen next? Second, conscious repetition. You must consciously repeat the 5 fundamental truths to yourself every day. Write them down. Put them on your trading desk. Say them out loud before you start trading. I don't need to know what will happen next. Anything can happen. I am here to take my edges and manage my risk. Third, trade as a probabilistic game. Start a trading journal, but not just a log of entries and exits. Journal about your mindset. After each trade, ask, did I take every valid signal? Did I predefine my risk? Did I follow my exit rules without hesitation? Did I think in terms of probabilities, or was I attached to the outcome? And fourth, reframe your definitions. Reframe losses as the cost of finding winning trades or business expenses. Reframe being wrong as gathering statistical data. Reframe missing a trade as preserving capital for my next edge. This is a process. It takes time. You will have setbacks. But every time you catch yourself blaming the market, every time you feel that pang of fear and take the trade anyway, every time you cut a loss according to your plan without emotional turmoil, you are strengthening the neural pathways of the professional trader. When you do this work consistently, something amazing begins to happen. You start to enter what athletes call the zone, and what Douglas describes as the ultimate state for a trader. The zone is not a state of intense concentration or trying hard. It's a state of effortless effort. It's a carefree state of mind where there is no fear, no hesitation, no internal conflict. You are completely focused in the now moment opportunity flow. You see the market with perfect clarity. Your actions are instinctive and correct. You take your signals without a second thought. You exit losing trades with a sense of purpose, not pain. You take profits systematically. You are disciplined, not because you are forcing yourself to be, but because it is the most natural expression of who you are as a trader. The zone is the natural byproduct of a mind that has embraced absolute responsibility, fully accepted the inherent risks of trading, internalized the 5 fundamental truths, and learn to think in pure probabilities. In the zone, you and the market are in sync. You are not fighting it. You are flowing with it. You are making yourself available to take what it offers without demanding anything from it. So let's bring it all home. The path to becoming a consistently profitable trader is a path of self-mastery. It's a journey from being a victim of your own psychology to being the master of your mental environment. You now have the blueprint, straight from the wisdom of Mark Douglas. Stop looking to the market for answers. The answers are in your mind. Take 100% responsibility for every outcome. Understand that your beliefs shape your reality on the charts. Cultivate a rock-solid belief in uncertainty. Adopt a casino mindset. Focus on your edge and the long-term series of trades. Align your expectations with the 5 fundamental truths to eliminate emotional risk. This is what separates the amateurs from the professionals. This is the profitable trader mindset. Your work begins now. Pick one thing from this video. Maybe it's taking absolute responsibility for your next 10 trades. Maybe it's writing down the 5 truths and reviewing them daily. Start the process. Debug your mental software, one line at a time. The unshakable, confident, and consistently profitable trader is a future projection of yourself. It's time to start growing into that person. Thank you for watching. If this resonated with you, please like, subscribe, and hit the notification bell. Share your biggest takeaway in the comments below. Let's build a community of traders who are mastering the inner game. Until next time, trade well and remember, the mind is the ultimate trading tool. Take care of it.